That's a little different. So this is due, when is this due? The 20th. This is due after Thanksgiving, right? Yes. Yeah, I just put it out there so that you had it since we're not meeting next week, and that's kind of what my email said when I sent it out. It was more meant for the people that are here, that you guys could ask questions if you saw it. It's 2 pages. One is briefer than the other. That's usually the biggest thing, and I've gotten even more specific with it. I used to be vaguer, right? But if you go to Chapter 2 and look at those 2 examples, that's what I'm looking for. And one of the reasons is, think about this, and for those of you, which is most of you, even the people I'm talking to on the recording, you haven't worked in public accounting. It's a whole different world, all right? And when I actually left public accounting, it was shocking, okay? So I worked, how many years did I work? I worked 10 years before public accounting, and now I've worked after public accounting. It was shocking to go in. It was shocking to come out. So you have to keep track of every 15 minutes of your time, because you're billing somebody. You're charging someone for that time. So if you're not billing somebody, then they're not really happy with you. As a staff, it's really important. As a manager, it's still important. As a partner, you're like 20% billable. The rest of the time is, I don't know. So when you're writing this memo, think about the fact that you had someone contact you for help. But yet at the same time, this might not be billable. This might be one of those things where you're giving some advice quickly that might lead to something down the road, which is something that you do sometimes, right? You give a little advice that might not take a lot of time. You might have some legal lower person go do the research for you real quick, intern, and then type it up. The last thing you want is to give a memo to them that is so detailed that they're going to pick up the phone and call you with an hour's worth of questions saying, well, I don't understand what section 162A-F is, and you referenced 4 court cases, and I tried to look them up, but I don't understand what this means. And if they got it in this case, but they didn't get it in this case, then why should I? That's not what you want. They want yes, no, there was a precedent set for this one, so I think you should do this. There wasn't a precedent set for this, so I would not go forward with this. That's why. And then in the memo to the file, you put why. Because you might not be there next year. Public accounting has huge turnover. Lawyers have huge turnover. That's why you put everything in a detailed memo to the file. So that in the event that she comes back, or she comes and wants someone to do her taxes and make that amendment, they can go to the file, they can find what you told them, they can find why, and then they can go ahead and get it filed. Yeah.
Call him a him.
A him, it's me, I know. Him, her, okay. Oh, I missed that one? Okay. I was typing and writing and trying to get it out at the same time. I will tweak that. But it is hard. And when I tell you what, when I first started teaching here after Leon, and I was actually still working there as a consultant, I remember the first couple times, one day I was sitting there talking to the 3 people out at Wildwood with me, and then they left, and then I was working on something, and then I got sidetracked, and I really wasn't that busy for a little bit. I was just kind of socializing, and all of a sudden I literally had a panic attack, and I was like, what am I going to code for my time? Because like an hour and a half had gone by, and I was kind of like, and I was like, oh, I don't have to put my time down. And I was kind of like, I don't have to do that. For like a minute, I thought, I have to code my time. What am I going to do? We just sat here and talked about how we're going to open this new campus, but it really wasn't anything specific. What am I going to do? And then I realized, oh, I don't have to worry about that anymore. That's kind of nice. So you need to think about that when you're writing the memo. Not specific. I write that all the time in my comments back to you guys. And remember, in order to submit it, what you're going to do, I think it's easier to do from here, is you're going to click on these black words that say research project. When you click on that, it opens it up. So you can see everything, which is what throws people off sometimes. But when you click on it, it takes you into the tab. Then when you scroll down, you see the due date again, the points. And then down here, browse my computer. Then you go and you attach your document, and you hit the submit. If you go in your grade book, you'll see something. It changed. It used to be an exclamation point. I don't know what it is now. But basically, it's going to say it needs grading. That's how you know it's there. All right. And I won't be grading them one at a time. So I will not grade them until after the due date. Because the other thing that happens is I grade 1 or 2 before the due date, and then someone says, oh, I was going to change it. Well, once I grade it, you can't change it. So I just wait until after the due date. Yes, I don't believe you, Katie. So we're not going to do that. So, all right. So, and I will answer questions, but I will not answer, does this look okay? I don't answer that part, okay? It's still and I will tell you this, yes, I do grade for grammar and those type of things, but you're writing memos, so it's going to have to be pretty bad for me to be upset with it. So, if you can read it and then you should be in decent shape, so keep that in mind, but at the same time, write good, all right? There still has been some bad ones that I've went through and I've been like, this sentence doesn't even make sense. So if the sentence doesn't make sense, then for me too, I'm an accountant, I'm not an English person, so if it doesn't make sense to me, we got a problem. Any questions on that? All right. Then we're going to go, not over there, over here, over here, over here, back over here. Oh, good job, Katie.
That's what they told me to do.
Okay, good. I said good job. I was clapping for you.
She wanted me to ask all the questions.
I just looked at it yesterday. I didn't start doing anything, so I figured.
Hey, you looked at it.
Knowledgeable.
Didn't I tell you guys you didn't have to do anything? I just posted it.
Yeah.
So that is not the right one.
So I was like, well, whatever questions she asked will help guide me when I may have the same questions later this week or next week.
Yeah.
Then I'm sure you'll text me anyway.
I probably will and say, wait, what did you ask in class?
It is literally something you have no homework due the week that you're doing it. So it's not anything that I really expected.
Is there homework due on Tuesday?
Chapter 12 is due Tuesday, and then you have the project. So it's in place of homework. So I didn't expect you.
Oh, so we don't have any homework when we're off that week.
Right.
It's due that Monday, then we're off this. And that's
Right.
due.
So this is in place, the research project is in place of homework. That's for you guys and the online, everybody. So you have homework due Tuesday, chapter 12's homework, and then, or Monday night, Tuesday, whenever yours is due. And then your research is due the following week. And then you only have one more assignment, chapter work. So probably over the next week, I will send out an announcement and I will post your final project also. All right? I would recommend that you're going to want to look at it. That's fine. But you want to get your research project done. All right? You don't want to be messing with your final project.
December 10th.
That is not due, right, until December 10th. So I probably am not going to get it out there too early. But at the same time, I want to make sure that you're given a full 2 weeks. And by the time we meet next, it's going to be really pushing that. So I will have it out there to make sure there is at least a full 2 weeks. And I'll definitely have it out there before we meet so you can see it before you come into class so you can ask questions, okay? And don't ask me what it is because I don't know, okay? I haven't done it yet. Why I have to do it before I post it?
Well, don't you guys know so they do all the
It is, but I haven't done it. They haven't come up with it. I can't just go out and find a project. I have to do it.
But it's the one.
It's the
with
final.
The
It's
1040 and
right.
the schedule
It's a
A.
1040, it's Schedule A, Schedule B, Schedule C, Schedule D,
Like
Schedule
what we
E,
got.
okay?
More schedules.
A whole bunch of schedules, yeah.
All right, chapter 12.
F chapter 12. Okay, so this chapter is interesting because we have to talk about AMT because it could possibly affect everybody. Could. But parts of AMT definitely go beyond what we talked about in this class. It's the smallest slides. If you guys went out and looked, I think there's 37 slides or something like that compared to our 72 or whatever we typically have in this class. So how I'm going to approach it is we're going to go through the slides, and on the ones that go beyond us, I'm going to mention it and we're going to go past it. All right? And then we're going to walk through a problem that encompasses almost everything at once, but we're going to walk through it together. All right? AMT can get confusing. It can be confusing to someone who does it all the time. All right? And that's okay. It can be confusing. I don't like it. I have to tell you. Who can tell me what the purpose of AMT is? So, let's retract. No political stuff when we're talking about all this, okay? Everyone's belief in AMT is completely different. Not everyone's belief is different. Everyone has a different viewpoint on AMT. How about that? What is the purpose? What was the purpose behind the creation of AMT?
This is about you.
No. What is the purpose behind AMT? Supposedly, it was to alleviate the inequalities in the taxes. Okay? And so when it was first created, what is believed is that as your income goes higher, you are able to take advantage of many more tax breaks and options than those that are in the lower tax brackets. So by being in the upper tax brackets, you are able to take advantage of those breaks, which then in fact reduces your income drastically. And those tax breaks aren't there for lower income individuals. So AMT was created, supposedly, and we'll go through some of the examples, where some of those tax breaks, when you hit a certain income, are not allowed for you. So you can't reduce your taxable income. And I think you've heard on TV and different things where people have said things like, well, I didn't even pay income tax last year. And it's probably going to be the wrong person, but I don't know if Trump said it or someone famous like that made a comment where they said, I didn't even pay taxes last year. Well, they paid taxes, but what they didn't have was anything owed or whatever at the end of the year. All right? So what came out of their paycheck was paid, but nothing, they had no taxable income at the end of the year. All right, well, that's a lot of tax breaks. All right? That's a lot of tax breaks. So AMT was created to alleviate some of the inequality between those that are in the high tax brackets and able to take advantage of all these tax advantages, and those that are not in that and not able to take advantage of those tax breaks. And so those are called preferences, and those are things that are back out of your taxes, and that's called AMT, which is why the tax form looks like this.
Didn't work.
Well, that's why we're talking about it, isn't it? That's why your tax form looks a little bit like this. All right, so I'm going to blow it up a little bit. So the EMT tax form starts. Now, we're not going to spend a lot of time on this because this form alone could give you a headache. All right, just looking at it. But it starts with the amount that you have on line 38, which is basically your taxable, your gross income, kind of all your income added up together. It's before you do all the adjustments to get to adjusted gross income. All right, and then you get to do several things that kind of stick out. Taxes from Schedule A, you're limited on taxes. Home mortgage interest, depending on what it's at. Miscellaneous deductions. We got a whole bunch of things that we're going to talk about that are very high level because they're higher income things. Things like depletion or interest on investment expenses, net operating losses, which we talked a little bit about, specific activity from private activity bonds, stock options, all right, excessive interest. Then they talk about depreciation and passive activity, mining, research and experimental costs. There's a whole bunch of these different but weird things that could be added back into your income. For the most common everyday person, if I were to be doing their taxes, are itemized deductions and exemptions, right?
Some Schedule K stuff on right.
There is some Schedule K stuff on here too. Those things get added back in. One of the biggest problems that has been very slow and low to be adjusted with AMT is the amount of which AMT hits. They adjust it, but they've been slow. So like when I mean slow, it's December 31st. So AMT, and I can't remember what the original amount, so I'm just going to give you some. Like maybe originally was $250,000 to $300,000. Well, $250,000 to $250,000 now is not near as astronomical as it was 10 to 15 years ago. It hasn't gone up like it should. So people, and if it doesn't continue to go up at the right rate, they were saying people that used to be way out of it, it's going to start hitting people that are like making $150,000 now. So things need to kind of change with how they're adjusting AMT. So with that being said, let's kind of go into it because I'm definitely not, when it comes to AMT, an expert. One of the many reasons I'm not an expert is because people I do taxes for don't hit it. I've had one person, for the most part, that I've done taxes over the years, hit it because him and his wife both work and they both make really good salaries, and they don't like it. So the example they give in here, and this is interesting, Bob and Carol are unmarried, they were engaged for 4 months, and they both work for the same company. They both earn the same amount of money, they have the same gross income, same investments, and consist solely of investment income. They have similar investments that produce identical investment income, and they have the same amount of deductions, but somehow Carol paid $15,000 more in income tax. Okay? So the question is, why don't they have the same tax liability? Were both returns prepared properly, which that's usually your first question, right? Should Carol consider getting a new tax return person? Should she file an amended return, or should Bob change something he's doing? Like, does he owe money and not realize it? So we'll look at it. So AMT is a separate form, but done at the same time. So it's that I showed you the form already. All right, computations begin with taxable income, and then what we're going to do is what's called adjustments and preferences to come up with what's called AMTI, alternative minimum taxable income. Still taxable income, but it's just alternative minimum taxable income. Yay. This is actually in your book. It's on page 12.3, and this is the formula. You love it, because even looking at it right here, when I try to page mark it for you, this looks overwhelming, all right? So it's your taxable income, you add adjustments, and you subtract preferences, all right? So that part should not be hard. Now, actually what's hard about that is what's the preferences and what's the adjustments. Because then what you get is an AMTI, and you subtract exemptions, just like we normally do. If you hit AMT, you get an exemption amount, which sometimes takes people out. That's how most of us don't pay, because we get an exemption, right? Most of us go out on exemption. That's called your AMT base. Then you have tax rates, 26 and 28%. Then you get an AMTI foreign tax, if there is, okay? Then you have your tax credit, which a lot of times that's not going to be anything. Then you get your AMT again. And then you have your regular tax liability. That's what we all owe. That's nothing new. If you already owed $2,000, then that would go there. If you were getting a refund of $2,000, that would go there. A lot of times, people are getting a refund until AMT hits. So that minus button might actually be more of a plus, plus button. All right. So what are adjustments and preferences? All right, many adjustments are just timing differences. They're timing differences, meaning in the long run, it doesn't make a difference. So for example, timing differences are going to reverse over time. Positive adjustments now are eventually going to reverse being offset by negative adjustments. Negative adjustments now are going to be offset down the road by positive adjustments. All right, so for example, depreciation. Regular income tax depreciation generates faster than AMT. So, if we were doing a Schedule C, our depreciation would go fast. AMT is going to make it go slower. So therefore, we have this big depreciation expense on our income tax, making our income lower, right? AMT is going to add some of that back, making our income go higher, being taxable. But over time, what's going to happen? We're going to get all of the depreciation eventually. It's just going to be slower. So it's not that you're never going to get it with AMT. You just have to walk a little slower to get it, right? So the negative adjustment will reverse later in the asset's life. So it eventually will come. Adjustments not related to timing differences will result in a permanent, and those are things like itemized deductions. Itemized deductions, you just lose. Preferences are designed to take back all or part of the tax deduction or benefit. All right? So in other words, regular income, starting point of AMT, is increased by preference items affecting disallowance of those benefiting AMT. That gets a little bit more confusing, and we'll walk through that in an example. Preferences include, and this is where I talk to you about some of the things we don't get into, because look at what we're talking about. Percentage of depletion in excess of basis. Percentage of depletion is a depreciation method, obviously. that gets into very detailed Schedule Cs. Right? You're talking about somebody who owns a corporation, that's not a corporation, who owns a business, could be an LLC, that's flowing through their individual tax return that's using percentage of completion as their depreciation method. Right? Excess intangible drilling costs. That's royalties coming in probably through a Schedule E, or it could be that they own a company that's doing that. And then interest on private activity bonds. Right? Those are preferences. Right? Very specific and very detailed that are going to be causing these AMT costs. Other components, exemptions. Exemptions reduce AMT. Those are set numbers that I'm going to give to you. Just like we used to have exemptions for everybody that did taxes, AMT has them. Exemptions, the higher, the more money you make, they're phased out 25 cents on a dollar. Just like exemptions, not exemptions, sorry. Other things used to be phased out for us. Exemptions weren't. These are phased out as well. So here's your exemptions for 2018. So $109,400 if you're married filing jointly. You get to reduce your income by that amount. Single, $70,000, and then married filing separately is half of the married filing jointly. The phase out begins at $1 million. So you get up to $1 million before they start phasing that out. You can see the income level that we're kind of talking about, right? Yeah.
Do you get both exemptions? Do you get the 24,000 and the 100,000?
Okay, first of all, 24,000 is not an exemption, it's a standard deduction. And this is only for AMT. This is only an exemption on the AMT 6251 form. And the 24,000 is a standard deduction, not an exemption. But if we still had exemptions, yes, you would have them both. They're two totally different things. Most of us will not be doing AMT.
What about the people that fall in between that?
But people that fall under this, yes, would get both. And they'd be very upset if you took this away. All right, AMT rates. For individuals, a graduated rate is applied. This is how you figure out how much they're going to be taxed. For the first $191,100, if they have to pay, is taxed at $26,000. For the rest of their income over that, it's taxed at 28%. So if they make over $191,000, that's taxable. That's taxable. Okay, we got to figure it out first if they're under AMT. Then the rest would be, so if they make $225,000, roughly $35,000 is going to be taxed at 28%. The first 191 is going to be taxed at 26%. Okay. The net capital gain and qualified dividends that fall under AMT are still going to be taxed at 0, 15, and 20. Those don't change. So you still would pull those out and tax them at the same amount. All right, tax credits and AMT liability. So personal non-refundable credits are allowed to offset any liability as well as any regular tax liability. So if you have those credits, they still can offset your tax liability. So those are still allowed to do that. And that's why if you look at your 1040, AMT is above those. So all those tax credits fall under AMT liability as well. AMT is added into your tax liability before you put those credits in. Credits come after you figure all this wonderful stuff out. Now, I love this next slide because we don't have a slide that's like this yet. Look at what it says. We've never had a slide that says 1 of 15. All right, most of our slides are like 1 of 4, 1 of 2, 1 of 15. This is where there's several that we're going to kind of go quickly over because we would not do an example like this. And as far as I can remember, I don't remember anything on the CPA that went into that detail. Now, AMT is on the CPA, and you got to know how to do AMT for the CPA exam. But I don't remember AMT asking me about drilling costs. And I don't remember AMT asking me about, depreciation possibly, okay? But I don't remember drilling. But like passive activity bonds, yes. But drilling costs, no. And royalties, I don't remember that either. The formula that we're going to walk through, yes. Knowing the 26 and 28%, yes. Knowing how to calculate AMTI, yes. Those things definitely. But not when, and there'll be a few other ones I'm going to tell you I wouldn't know, okay?
For the CPA exam, do you have to memorize all the thresholds and everything?
the CPA exam? Yes. That's why you can take it in pieces now. Different things you can remember. There's a lot of, I don't know if you guys can help me remember, I can't remember what they're called, where it's like, you can say a saying, like, I love cats that run around in circles, and the first letter of each one of those things stands for something. Mnemonics, is that it?
Mnemonic device.
Yeah. So there was, I mean, I would go into the one section of the CPA exam, and I would have 15 mnemonics that I would be going through. And as soon as they say start the test, now the test is different for you guys than it is when I would sit down and I'd be like, I love dogs that run in circles. Cats wear red dresses. I mean, it doesn't matter what it was. And I'd write down each one of them and what it stood for, and then I'd start the test. I mean, any test I'd take, and I tell my financial students this, I say start the test, the first thing, assets equal liabilities plus stock equity, net income is this, and blah, blah. Even though you know it, it's the first thing you should do when you start taking a test, that is a closed book test, is write down everything, do a data dump on a piece of paper, but yet I look at tests, there's no data dumps going on, you know, so whenever you have a closed book test, that's why I don't do a closed book test in here, and that's why I even just took it online, because when you took it face to face, it was an open book, you know. I don't expect to memorize, and the CPA exam has evolved over time to where you guys are back to one section at a time. I still had to take it 5 and 4 sections, two in each day, and you had to pass 2 at a time, and it sucked. You know, now at least I went back to 1, where you can concentrate at one at a time and kind of get that one done, and then go on to the next one, which I think is better. Huh?
I don't have the phase out or threshold.
I don't, you know, that would be interesting. I don't know if you have to have the phase outs. Thresholds, yes. Phase outs, I don't know. That would be interesting. I don't know. I honestly believe if you're going to take CPA exam, you got to have a review course, because questions like that are answered in them. I mean, I know it sucks to pay the money, but you're going to pass it so much faster that you're going to recoup that money. It's hard to do it. I didn't want to spend it because I didn't have anybody paying me back either, but it was worth it. Yeah. But the CPA will repay it back. All right, so first adjustment, MACRs. We just talked about MACRs, right? Modified Accelerated Cost Recovery. It applies for, recovery periods apply for AMT depreciation, but so there's no adjustment period for real property depreciation. So we're good there. For real property placed in service after 1986, AMT depreciation is computed under alternative depreciation system, which we saw when we did that chapter. It was one of the charts. We didn't do anything because for tax purposes, we do MACRs. But for AMT, they do ADS. Okay, MACRs does 27.5, 31.5, and 39. ADS does 40. So that means we're going to have an adjustment. Depreciation for that is not done the same way. We have to do it over 40 years. There's going to be an adjustment. Remember I said AMT does it slower. 40 years is definitely slower than 27.5 years, isn't it?
Yeah.
All right. So that's one of the adjustments. That would be an adjustment I would think you could see on exam. Yes?
So why are we doing depreciation slower?
I can't tell you why AMT does it slower. That I can't give you the answer to. It does. Somebody somewhere thought that would be a good idea, that is somewhere where more people, my only thought to it, Katie, honestly, is that people with money have more means to have more things in which they can depreciate, and depreciation allows you to reduce your taxable income because then it's an expense.
Am I just trying to get you to do more taxes?
No, they're trying to get people of higher income to not be able to go down to a taxable income of 0. Whereas people with lower income don't have the ability to own 15 buildings. If you have 15 buildings, I'm going to give you an ethics, we're going to go through an ethics example in a little bit that I think kind of points out a gray line. But the more money you have, the more money you can do things, right?
Yeah.
The more money you can do things, the more advantages you can have. If you can have 15 buildings and you depreciate them all at 27.5, then you have a huge amount of depreciation expense that could technically take you down to no taxable income. What this is saying is, let's stretch that out. Let's make it equitable to everybody. People that have money will argue, hey, just because I have money and can have 15 buildings, why is that my fault?
That's true.
We didn't say it was your fault. We said we didn't care.
Right. So I am not
But if
saying.
you have money and you were up there, you would agree. Just
Right,
saying.
right. So it just, we're not arguing the validity of AMT, we're telling you why the thought process was in it. It was to make the tax system more equitable between all levels and to make sure everybody was paying their share of the taxes coming in. Because what was felt was that because of these tax breaks, the upper was not putting in near the same share proportionally as the middle and lower.
A lot of the stuff we're talking about though is like, you see like a Schedule K, or you see from people who have their own businesses, now that's not necessarily.
Not unless they make a lot of money. You're not paying AMT unless you make a lot of money. This is only if you're paying AMT. AMT is only paid at the higher incomes. Okay? Yeah. All right. Macro's recovery period. Depreciation adjustments is driven by the difference in depreciation percentages. So, for example, personal property is depreciated using double declining. All right, for tax purposes, adjustment is going to be required using 150%. So you can't take it as fast. So when we do things for ourselves, for a business, we can do 200%. AMT is going to make us do 150. Slow it down. If you use additional first-year depreciation, bonus is eligible. You do not have to do no depreciation adjustment for AMT is required, so you don't have to do anything there.
What's DB?
Double declining.
Oh. Okay.
Pollution controls. This is one of the ones I told you about. We don't talk about pollution, but they do ADS. You have to do it over 60 versus the life of the asset. So that was one of them. Circulation expenditures. You have to amortize them differently. Again, another one. Those two, I'd be shocked if you saw that on the CPA exam. Here's the mining and exploration that I had mentioned. For AMT, you have to do it over 10 years. Taxpayers can actually capitalize it. Now this one is a little different, the completed contract method, which if you've gone through intermediate or intermediate 2, AMT, you have to use the percentage of completion versus the completed contract. You've hopefully heard of both those, so you actually do need to know both those methods for the CPA exam. Where you're going to use them, I just recommend you know them. But for AMT, you actually have to use the completed contract. Percentage of completion. Incentive stock options. This is something that comes up because stock options, incentives for stock options do happen much more often for higher income levels, typically because those are typically executive type, what's the word I'm looking for? Bonus plans. So they can create income for AMT purposes that is definitely not currently taxable for regular taxable purposes. So it's the fair market value over the price is the adjustment that you're going to make. All right, so whatever the price you paid, the fair market value over that is the adjustment that you're going to be making. And, gains or losses. This is going to be the difference here. You know, we went through gains and losses, and we looked at the difference, right? We looked at the difference in the gain or loss based on the adjusted basis, and then whatever it was sold at, and we got to add different things in depending on what type of thing we sold, whether it was stock or a piece of property. So if the adjusted basis of an asset differs from the regular tax AMT, the gain or loss is recognized when you dispose of the asset on the 2 tax system. Difference between the gain or loss is the adjustment. Very confusing. Again, we're going to walk through that one. The other ones we're not going to see. Passive activity losses, not deductible in computer either one, because we can't deduct passive activity losses, right? You can only deduct them up to their gains. Passive activity losses, though, must be recomputed for AMT using AMT provisions. So we'd have to go through some AMT provisions to make sure they're actually losses, especially if they offset gains. We're almost done with these wonderful adjustments. Net operating losses must also be recomputed. All right, they're going to start at an alternate tax net operating loss, which again, we're not going to go through. One of the things this would be, there's no true class here, but if you were to go into accounting, with a tax emphasis, there's advanced tax classes. You don't even have to sit for the CPA exam. I never took an advanced tax class that would go into some significant details on things like net operating losses. And then these are itemized deductions that you can have. So this is a section that you would want to know. All right? You can have casualty losses. You can have gambling losses, charitable contributions, medical expenses in excess of 7.5, and qualified interest. So these might differ from some tax returns because things like student loan, qualified interest, and investment interest are the deductible for AMTs. Not all interest is deductible. Those three.
Is gambling loss is still
Only to the gain. Yep. So itemized deductions allowed for AMT. Those are it. Itemized deductions not allowed. Taxes. Now, granted, now they're only up to $10,000, but taxes, all right, they are not allowed. So you got to back those out. You cannot take taxes for AMT. That's why I think it was the second or third item down when I showed you the 6251 was taxes. All right. Before the $10,000 limit, that could have been a really big amount added back in. All right. Gross income may include a refund. All right. That could result in a negative adjustment. So like when you get a refund back from a prior year, that would be a negative adjustment. AMT deductions allow for interest expense, includes only qualified housing. All right, that's what we were talking about before. So things like other interest does not get included. And I think this is the last one. AMT does not allow the standard deduction. All right, so it enters this yes. Have to itemize. Yep. So this adjustment enters the AMTI calculation indirectly by adjusting the taxable income, but that's it.
So can we go back to the
Which?
taxes? I minus for taxes real quick.
This one?
Yeah, so when you're on the form,
Mm-hmm.
you need to add back, do you add only back in only 10?
Going forward, yes. You're only going to add back in what you took out.
Okay.
Yes. That's a good question. So before it was add back in everything, but now you can only up to 10,000. You're only going to add in what you took out. All right, so a couple things and then we're going to look at this problem. So preferences tend to arise because of what deductions or exclusions that provided a substantial tax benefit. So before we were talking about adjustments because the government decided that these were inequitable, okay? Preferences, unlike adjustments, are only positive, meaning they're only going to increase your income. Adjustments could decrease your income, and they could increase your income. They could go either way. Preferences only increase your income because they provided a substantial regular tax benefit. All right, so basically they decided along the way this was way too much. All right, thus the preferences reduce the benefit received of your regular tax benefit. Percentage of depletion. All right, it's decided that preference in the amount of percentage depletion taken for regular tax in which the excess of the adjusted basis of the property at your end. Very detailed. Getting into the percentage of depletion, I sat in there looking going, can I come up with an example that's going to be relevant for what we're talking about? My answer was no. But again, you're talking about a Schedule C. You're talking about someone that's using percentage depletion, and so it's a very detailed tax return that someone's taken that on. Intangible drilling costs. Again, either a royalty or a Schedule C, one of the two. Deductible currently for regular taxes, but you can see what they're going through. Deduction if IDCs were capitalized, and then they're going 65% of net oil and gas and thermal income. Very detailed. Very surprised if you would see this on the CPA exam or your EA exam. And then interest on private activity bonds. Possibly. Okay, this is where I would expect a preference question if you were to get asked one on AMT, would be private activity bonds. All right? Not taxable. We don't, for the most part, we don't pay tax on private activity bonds on our regular tax return. All right? But you will have to include that interest for AMT. Why? Most of us will never have a private activity bond. That's a great question. What I believe a private activity bond is more along the lines of, remember we talked about bonds and financial? Bonds that people can invest in outside of the big, that. Private bonds that can be invested in on the private scale in large dollar amounts. And the interest that you gain on those bonds.
Not like when you buy it.
No, not the bonds that you and I can go to the savings. No, not those bonds. Big bonds. I feel like I'm just Jack. Will and Grace. Big bonds.
Big
Yeah,
bucks.
yeah. Big bonds. Expenses incurred in carrying those bonds are not deductible for tax purposes, but they can offset your interest for this purpose. And interest on these bonds issued after 2008 but before 2011 is not treated as a tax preference. I believe that reason is because of the downfall of the economy, so they're treated separately. Every other private activity bond is not. And then the gain or sale of certain small business stock is excludable from gross income for regular tax purposes if it was acquired after 2010. Again, economy, okay, the whole thing was buy small business stock, 2010. But for AMT, for years in which 100% exclusion applies, the exclusion does not create, so this one actually is positive. If it's 100% excluded for regular, then it is not a preference here. All right, so let's look at their big picture real quick. Bob and Carol both have invested substantial amounts in private activity bonds, the last thing we talked about, all right, which were all issued in 2010. Real quickly, what did we say about 2010?
It was excluded because
Right. For AMT purposes, for years in which 100% exclusion applies. So that might be the kicker here, right? Were their bonds 100%? I'm going back over there.
But that's alongside, that's not for private bonds.
Oh, you're right. That's the stock. Here we go. 2008 to 2011. Okay, thank you. I was talking about companies. All right. Both Carol. Okay, a tax preference does not result for either Carol or Bob. I could have kept reading that and I wouldn't have had to do that. All right. All right, so now AMT credits. So do they have credits going forward? What did I tell you guys about credits? If I make this go away real quick and you can't see it, what did I tell you about credits?
They like
Credits are better than what?
Deduction.
Okay, overall, she remembered that. That's good. Credits are better than deductions. Always better than deductions. And what else did I say today? What did I say about AMT credits?
I thought they like can contradict each other, kinda.
It can either be
It
good or
can-
bad. Up or
yeah.
down.
It can be
Up or
used. I thought it could be used. Dang
Or
it,
you were
I
against
can't
it.
remember.
All
You
right.
either make your AMTI go up or down.
Okay. All right, so we'll go with both those. Okay.
Something like that.
All right. AMT attributable to timing difference can create a credit. All right, so timing difference can create a credit. Excess of AMT over AMT computed without timing difference. So basically, if it's not a timing difference, it can create this credit. AMT credit can be carried forward indefinitely, all right, to be used to offset another tax liability. Regular tax liability in excess of a regular tax liability over AMT, thus the credit cannot reduce a tentative minimum tax. It only can reduce the actual liability. And there's no corporate AMT beginning in 2017. We still have personal AMT, but no corporate AMT. I heard a lot of groans over that. Not enough because I don't know enough people that pay it, but a lot of groans that corporate AMT is gone, but not individual AMT. All right, so let's go back again. So Adam asked his preparer if he underpaid $15,000. Adam examines his two returns and finds that the difference relates to the treatment of interest earned on two exempt bonds. Both Carol and Bob owned tax-exempt bonds, including private activity bonds. However, Carol's accountant overlooked that the interest on the bond is not a tax preference where the bonds were issued in 2010. Thus, the $15,000 AMT that was reported on Carol's form 106251 was an error. So it wasn't that one owed it and one didn't, all right, which when I first looked at this, I thought maybe one of them had a credit coming forward that the other one didn't have. I also thought maybe one of them had some passive something that they didn't talk about because they just said their income was all the same, right? I thought maybe they earned it differently or they bought it at different times. But it was actually a mistake. I wasn't leaning towards that when I first started looking at it.
So Bob's account excluded it because it was exempt.
Right,
But
and Carol's did not.
Carol needs a new tax.
Carol needs a new tax account, exactly. All right, or you can say sometimes people make mistakes. One time. After that, you need a new tax account. Okay, so the first thing we're going to look at is on page 1244, and it's just in general about why do we pay, well, that's not the button I wanted to hit. Okay. Why do we pay AMT? Okay, there we go. Let me shrink it just a little bit. All right. So if you have your book, great. It's on page 12.4. If you don't, I think you should be able to read that. Well, I might have to shrink it a little bit more. Hang on.
You talked about it so bad we came prepared.
Okay. I think it's still, hang on, just a little bit more. I don't think you can see that. Can you see this all the way in here? There we go. I gotta hold it down. Freeze it. Now you just get my finger. Okay. Hopefully you can read that a little bit. Look it up. I pulled it up in the ebook. So this is the problem that we're going to take a look at. All right. So this is actually in your book. It's on page 1220 if you're looking at your book. All right. So it starts off, Molly is single and 56, and she lives in Texas. All right. And this is the information that we're given on Molly. All right. Molly has a salary of $292,000. And she makes $18,000 in interest. So her adjusted gross income is $310,000. Right? Molly's doing pretty well. All right, because also I think it said, she's 56. I thought it said 36. So Molly's 56 years old. She has no medical expenses that exceed 7.5%. Her state income taxes are $9,500. Her home mortgage for qualified is $20,000, so they've already asterisked that. Her investment interest is $6,300, and then she has charitable contributions of $15,000, and then she had a casualty loss, which you can see they already took the 10% of AGI off, which amounted to $17,000. So she had a loss, but they've already done that like you normally would. So her itemized deductions were $67,800. All right. One of the reasons itemized deductions are looked at is because obviously the more money you make, the more itemized deductions you can have, right? But they only look at some of them. All right, so that's the information that we start with, all right? Deductions that are marked with an asterisk, all right, are allowed for AMT. So we can take the mortgage, the investment interest, the cash contributions, and the casualty loss. We cannot take the state income tax, so we're going to have to add that guy back. All right? So now if we go down to the next page, we find out that Molly also earned $40,000 interest on a private activity bond that was issued in 2014. Does anybody remember the year?
2011, 2008 to 2011.
2008 to 2011, okay. She would also exercise stock options in 2018. The options, the difference between the excise price and the fair market value, was $35,000. Remember, that was one of the things we had to know. What was the difference in the price? All right. Molly's regular tax liability would have been $60,460. She would have owed $60,000 for $460. So we start with her taxable income, $242,000. We have to add back her state income tax. We have to add in her options, the fair market that exceeded the fair market value, and we have to add in the interest on the private activity bonds because those were not taxable for normal tax purposes because private activity bonds are tax-free for normal tax purposes, but they're taxable for AMT. So we have to add that. So her new AMTI is $326,700. So her income just jumped, right? Her exemption, because she's single, is $70,300. That's given to us. That was one of the numbers that was given to you. All right, so her base is 256,400. So now the next couple numbers were also given to you. The first is the fact that the first 191,000 is going to be taxed at 26%, and anything over that's going to be taxed at 28%, which gives us 67,970. She already knew she was going to owe 60,000. So now she's going to owe another $7,510.
Not that bad.
Well, not when you already owe 60, but because of her income, she owes another 7,510. You tell that to somebody who owes the money, they're not going to be happy. All right.
I thought it would have been like, I mean, granted, she doesn't make like a crap ton over what
Right.
that was, but I guess I was thinking it was going to be like,
No. Right.
yeah, like a lot. But I guess,
Well,
like
one
you
of the
said,
things
you add in
with
what she already
exemptions
owed.
used to be added back. We don't have exemptions anymore. So the one or two people that I knew that had it added back in the past had 3 kids and themselves, that's 5 exemptions. You add that back in and you have someone who's not making that much, but making 207 some thousand, adding back 20 some $1,000 and then being taxed on that, and you're telling someone who used to get money back that they owe $2,000 in taxes. That sucks. Yep. All right, so let's see. If I go back up, does it show me my next thing? I don't know if it does. If not, I'll put it on the overhead. It does not. Okay, so we'll go back over here. This one I like a lot because I'm curious to your guys's
What page is
viewpoint. This is on page 1220. I know, you're going to have to read it on the screen.
it? Oh, it's on the same page.
It's basically the same. I'm not going to, oh, it's still frozen.
Unfroze.
Hang on, I'll focus it. Sometimes it's clear.
It's too light on that side.
It's too light on this side.
When it goes into the binding.
Like the trees.
Yeah.
Yeah, there you go.
There we go. Let me freeze it. There. Is that better?
Yeah.